Hilton brings you new ways to stay, with experiences that let you capture the glory days. Introducing the Graduate Hotels. Each inspired by local college towns, these stays are always original and never boring. Get in touch with traditions all across the country and enjoy a stay that's a class above the rest. Book at Graduate Hotels with Hilton Honors Points at Hilton.com. It's a win-win. Hilton, for the stay.
Reality radio for a really great future. We're talking real money.
Well, welcome to Talking Real Money on this beautiful Saturday afternoon. I'm Tom Cock. Don McDonald on the road. Be joining us here in just a couple of minutes. You out there trying to figure out, what do I do with my money? How do I make it grow? How do I take care of it? What are the mistakes I need to avoid? And that's why we're here every week to answer all of those questions. And the idea is to give you actual answers to your questions without selling you anything. Now, we're not in the business of telling you to call us Monday morning. Well, actually, in this case, it'd be Tuesday. Call us Tuesday morning and we'll fix all that up for you. We actually give you some answers to real life questions that we see every day. We've been doing this a long time, and the idea is to get you on your way with less worry, generally with more money, because many of you are making a lot of mistakes when it comes to how you're taking care of assets or not that you're probably going to need in the future. So that's the deal.
Yeah, the point you're trying to make is that unlike all of those other radio shows, and I know you tune in on the weekend now to stations and you go, oh no, not another financial pitch.
Not those guys.
You are not going to get one here. Bear in mind, and this is important, those other people are purveyors of product. They sell insurance products, they sell stocks, they sell heavily loaded mutual funds with high fees. They sell. It's like the Ed Jones guy knocking on the door. Hello, might I talk with you about investing?
I love how most people don't even open the door.
Yeah.
They talk to them through the door.
Gosh.
Good Lord, I'm not even going to open this. So,
I thought Fuller brushes died off years ago.
They make these kids go door to door. That's no
door
joke.
To door.
We learned this. It's actually
because we've actually we've actually interviewed some of them. Because we're looking for new advisors, and here's the thing: is we're looking for people who are disenchanted with the sales industry, the financial sales industry. You don't keep your job unless you're making your quota. I mean, literally, when I was in the business, there was a board on the wall where they had everybody's sales month to date. And if you knew that if you were in the bottom half of that board,
don't be last.
Good chance you weren't going to be there next month.
Yeah. And in
it's
the
brutal.
cases of some of these young people we've talked to, they didn't make the cut. I don't think it's any of the fault of their own. I think if you put me going door to door, I wouldn't do very well.
You
I wouldn't
imagine?
do very well. Well, I might do better than they do because my hair color, being blonde as it is. So, but anyway, I don't think I'd do well.
They'd go, "Who's that poor old homeless man at the door?
Get that guy out of my front yard. He's going to steal
something. He sure has a nice suit, but he's just too old to be going door to door."
I know. So
I did door-to-door sales when I was a kid.
Did you?
I mean, very young, because my mom got caught up in an MLM thing.
Oh no!
Back in the 60s, it was selling a product called Swipe. I like Swipe. And I went door to door.
What was Swipe? What was that?
Swipe was a blue all-purpose household cleaner. It still exists. And, we don't begrudge anyone making a living as long as it's an honest living. Sure. I don't even begrudge people door-to-door sales. It's a hard job. And,
it is.
And somebody's got to do it. But one of the things I don't like multi-level marketing. I hate multi-level marketing. That's one of the reasons I kind of make faces when I talk about it. But you sold door-to-door?
I did.
I mean, I remember your days selling commodities, but
that's going back a few years too. No, this was I was going to make you try to guess what I sold door to door, but I figured you're never going to figure this one out. Not a chance. I mean, unless it's Encyclopedia Britannica's, I don't have it. Which I think they were still doing when I was young. No, I sold holly door to door, the plant.
Oh, I thought you were a pimp.
Yeah, I was waiting for the smart reply. No, so it turned out when we moved to the Northwest, we had a humongous holly tree. I mean, like, and my dad said, some of your neighbors would probably love to have some of those holly sprigs for the holiday. So I went around the neighborhood and I sold bags of holly. So I took the orders.
A serious entrepreneur.
Yeah, well, it was I got to give full credit. It was my dad's idea. And I said, sure, that'd be great. Get $10 a bag or something. So I sold a bunch of bags of holly. I'd take the orders and I'd come bring it back, a week later, and boom, there you go. So.
A lot smarter than me going out and mowing lawns in the miserable weather. Or, I had a smart one. I used to sell my sibling stuff out in front of the yard. I would just take their stuff.
Now, that's way more creative than trimming the holly tree.
David, you don't need that. David, you don't need it. Seriously, it's okay. Yeah. And I'll give you half the money I got from it.
Oh, I never thought, actually, that raises a very interesting idea because, as you know, in my house.
I didn't think it would.
Well,
I was surprised.
It does because, as you know, in my house, things come in and then they sit there. They oftentimes don't get used. And as you know, my wife works all the time. I could actually do one of those sales while she was gone with all the things.
She wouldn't miss it.
And she'd be home. Whatever happened? I don't know. It just disappeared. I like where we're going with this.
She'd never miss it. Never miss it. And we're going to do the same thing. We got a lot of stuff to sell. Right, Debbie?
Yeah, right. Good luck with that.
My wife's here with me. In beautiful Rapid City, tomorrow it will be almost 100 degrees.
Well, almost 100 here, too. So.
Really? Is it that hot there?
It's going to be 90 again, I think.
What happened to Seattle weather?
It's over. It's never going to rain here again. I just talked to Steve Poole, Como 4 News. He said, that's it. No more rain.
That's it forever?
That's it.
Oh.
Taking the top off
Florida,
my car.
So I get a little humidity.
Exactly.
Now, I just figured out, thanks to Mark Hulbert, why we have a Labor Day weekend to start off September. I always wondered what the real purpose was, because it couldn't just be, come on, Labor Day.
Well, I thought it was like increased number of pregnancies from early last year.
Yeah, no, it's not that.
Okay, all right. So
yeah, which is better than mine, because all across the country are people in their cars either listening to the podcast or listening to the show on the radio, and the little kid in the backseat going, "Mommy, what's a pimp?"
Thanks a lot. Yeah,
you're
appreciate
welcome.
It.
It's never mind. The reason is this is, according to statisticians, September is the worst month of the year for the stock market. Did you know that?
I think somewhere way back in the back of my mind, because as you know, I don't really look month to month at these things. But
yeah, we don't pay any attention, but people do.
Yes, they do.
They're like there are a lot of short termers quaking in their boots, thinking, "Well, it's September. What should I do now?"
Sell it all.
Mark Hulbert, he's a statistician. He loves statistics.
And he wrote that absolutely great newsletter all those years that I think he
following
sold to Mark
all those newsletters. Yeah.
And he, by the way, if you really got him out and said, "What do you think?" he'd say, "Just buy an index fund. These people don't know the future. Give me a break."
He debunks, and that's the nicest thing about Hulbert's work, is he regularly debunks those who believe
hottest newsletter
they
writer
found
of all
a
time.
pattern.
Not happening.
And all of these folks who believe they found a pattern, you should stay out in September, because statistically September is the worst month of the year. And so he ran it by a whole bunch of statisticians, and they, in essence, said, I could read you all the details, but in essence, they said, even though it has been the worst month, that doesn't mean, and there's no reason to believe that it will continue to be. There is no logical reason for it to be that way. So it's much more Occam's razor. Simplest solution is probably the most likely. The simplest explanation in this case is it was just luck.
Well,
like flipping a coin.
But I do think, there is this aspect of people come back to work in September.
Yeah.
So then you got more trading, and if things look, not as bright as they did, now you're going to have more money moving around, and so you could get into all that.
And in addition to what Hulbert talked about, I have always had the theory that plays into it, but it also is when you have a bunch of people playing in the market, not investing in the market, but playing the market, thinking that there is a pattern, that there's a system, that it becomes a self-fulfilling prophecy.
Well, true.
They look back at years past and go, well, because these years past, the market was down in September, let's get out in September and get back in later in the year, or get back in at the first of the year. So we have a lot of selling that happens just because it happened before for no apparent reason. What's going to be very interesting to watch over the next several years, Tom, is what is the impact of indexing and passive investing going to be on those kinds of self-fulfilling prophecies going forward as that percentage of the market grows and grows dramatically, or at least it has so far.
I mean, you go back 20 years, it was about 1 out of every $20 that was invested in stocks this way. Today, it's about 1 out of 3. I mean, it depends on which number you believe, but some people say it's as high as 40% of the money in stocks.
I saw a 42%.
Yeah, so it depends
on
your
number. I saw a 42% number. But my question is, though, and this is what I really want us all to watch, is are we going to have, we're going to predict that we will because we've had them before. We're going to have big market crashes, but are they likely to be as dramatic?
Oh, you think I get what you're saying is, or you think they're going to be
less?
I'm saying? Because
right.
People are I'm invested, and the markets go up, the markets go down. Get over it.
Well, and like we do with dimensional funds advisors don't let their clients panic out in a declining
you gotta be careful
market.
How you say that. They
don't. They discourage them.
Okay, there you go.
Yeah. Well, you can slap their hands. You really can't force them, but you can.
It's your money.
You can gently nudge them in the right direction.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And again, we want to help you. We want to help you make more money in the future, to make more sense out of money, to understand how it works, to particularly understand how investing works as opposed to speculation and gambling and playing.
So the question is, should your investing be like work? I mean, shouldn't it be a hard thing? You always get in. I mean, this is the part that.
Yeah.
I love this discussion.
The argument has been by many on Wall Street that the harder you work at investing, the better you're going to do. You got to put in the effort if you want the return.
Well, because that's one of the core beliefs of America, right? The harder, the more you get ahead, et cetera, et cetera. So the question is, as an investor, is that true?
Well, here I have a great analogy for you. The guys out digging ditches by the highway work really, really hard. Are they making a lot of money for that incredible effort they're putting out? Generally speaking, not. People who work really, really smart, not breaking a sweat, but working smart, tend to make more money. When you work with your brain, you tend to make more money. Smart investors tend to make more money than those who struggle and research and study and time and trade. And they're actually they're doing the equivalent of breaking a sweat working on their investment portfolio.
Well, and my answer was absolutely not. That most people that work hard at this end up with less. The people that try to research and pick individual companies that are, I think this company is going to be better than other. The people that try, because you mentioned being out in September, the people that sort of try to time markets, either with a system or with a feeling, right? And then the people that, this is my favorite, the people that are so sure that they can do this better than the experts. In other words, the people that sit at home, and I'm going to tell a story later.
We know many of them.
Yeah, that is a guy I've known for a long time, and he's a smart guy. I saw him last night, and he's just sure that he can.
Now he's going to know who he is.
I know. He's just sure that he can do this. That he can beat the market. That's the word. That it's all about beating, and that's, by the way, that's what he thinks investing is. He's certain that that's how you get rich. Well, it's one way if you could do it. The problem is we can't find anybody who can do it for a long period of time.
See, the cheaters have given some credibility to this concept of beating the market because there have been so many people like Stephen Cohen who run, big hedge funds.
Back in the news this week, by the way.
These guys, there's no doubt about it. They cheat. That's how they win. They don't win by being smarter.
You can read the book there, and you very clearly see that black edge, right? Yeah, I mean that.
Yeah, when SAC Capital pleaded guilty to insider trading,
what was it?
Paid a $2 billion, $3 billion fine. It was a multi-billion-dollar fine.
Pocket change.
Paul, welcome to the show.
Hey, Paul, how are you?
I'm good. How are you?
Doing great. How can we help you today?
I have a universal life insurance policy, which started out as a whole life, but I purchased when I was 18. I paid $10 a month for a while, then I increased it to $28.30, which had stayed there for decades. I've got about a $21,000 cash value in it. I really don't need it. I just wondered if you had any ideas what I might do with that.
Well, what's the policy payout in the event of your demise?
It pays $50,000, but I think part of that is the 20 that, you know.
Oh, of course it is.
No question about
I'm
that.
not sure how it works.
How old are you, Paul?
65.
65.
And do you have any dependents who might need? I mean, because I sadly just heard about a case. Go ahead.
No, my kids are in their mid-30s, doing fine, and I'm not remarried. So.
Yeah, because I just heard about a horrible case with somebody in their 40s that passed away with no insurance and left the wife and kids with nothing. Yeah. I mean, if you're asking me, again, this gets into what's the purpose of insurance. Generally, the purpose of insurance should be to pay in case something happens to you, to take care of others, generally.
Right.
I originally bought that policy because I wanted to be responsible for my burial. I didn't want nobody to have to spend money to bury me. That's why I bought it.
Well, here's the deal. This really is what it boils down to. If you want to keep that money very safe, if you were going to take it out and put it in something very safe, it would not reach $50,000 for at least a couple of decades. So if you pass before you reach 85, leaving it here is a safe way to, as you said, pay for your burial and leave
party,
something to your kids.
There you go.
And a party or something.
Okay.
But if you would take it out, for example, and invest it in the stock market, let's just say you didn't need it, you want invest in the stock market, there's a decent chance, although there's absolutely no guarantee, that 10 or 12 years from now, that money would be worth about $50,000.
Yeah, that's true. Okay.
So that's the game. You got. You would have some taxes. Yeah, you would have some taxes on the proceeds, on the gain on the proceeds. But it's not going to be, because you didn't make a lot of money. I was just roughly running some numbers, and you probably made less than 1% a year. It really didn't make a lot of money, so you're not going to have a huge income tax, but it will be taxed as ordinary income. My first inclination, given that you've already done it, it's already there, you don't need the money, would be to leave it alone and let it pay for your burial down the road at some point, and because its cash value will never, ever, ever, ever meet the death benefit. It just can't.
Right. Okay.
Okay.
But you can see. Yeah, there's options there, Paul, for you. I think it's a fair debate again for looking down the road. Again,
it's as simple as this: if you're not going to take risk. If you would take it out, pay the taxes, and not take risk, you want safe investments that are low yielding, there is no way you're going to reach $50,000 in value before you're 85 years old. It's just not going to happen. If you take some risk, it could happen a lot sooner, but you have to take risk. And if it's money you don't really need, you've got a guarantee for your beneficiaries. Those are your choices. Thanks for the call.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Hi, just by way of introduction, I'm Don. That guy over there is Tom. This is Talking Real Money, the show that we host, designed specifically and scientifically to help you build the wealth you need to retire the way you deserve to retire, which is well, comfortably, securely, happily ever after. And let's go back to those phone lines and bring Carl aboard. Hello, Carl. Welcome to Talking Real Money.
Hi, gentlemen. It's a pleasure to be on your show, and I thoroughly enjoy it, too.
Thank you.
I am an exception to your rule. And way back when, probably over 10 years ago, I bought an iPod, and I thought it was an exceptional piece of electronics, and decided that probably that company would be worth investing in. So I bought a number of shares of Apple, and I still have it.
You know, you were actually,
you're the only guy who's ever done that, Carl, so well done. No, kidding.
No, you're an exception in a couple of interesting ways, because along the way, what you did something that is actually in some ways a very good thing. You bought something that you thought was good, and you just hung on. The problem is very few people, Tom's right, very few people actually bought it and then hung on through pancreatic cancer and all, and the demise of the company's founder and all of the things that happened, the bad news along the way, really, it hurts people. It almost physically hurts sometimes, and that's why it's hard for individuals to buy stock. The other thing you got was lucky.
Yeah.
No, and by the way, I don't want people to misunderstand. Even though we criticize owning individual stocks, we're happy for you. I look, if everybody bought Amazon in 1997 with $1,000, you wouldn't need to call us, probably, right?
But the problem right now is I look out there and go, okay, I've got matter of fact, I am broadcasting this show.
He's got
literally,
Mr.
I am
Apple.
broadcasting this show through my iPhone. You are hearing this show going from my iPhone to the studios in Seattle. So I think these are incredible devices. What's the next one?
Well, the next one I feel is obviously 8, and I feel that pretty soon.
No. What's the next big win?
Portfolio.
Yeah. No, I guess what I'm saying is you won on Apple. Are you confident you're going to pick another one like that?
Well, I'm 71 now, so I've made my retirement. Absolutely.
You won.
You won the game.
And
well
that's all
done.
I can say.
We're happy.
You did. Well done.
I'm in high 6 figures.
Good man. Well, so do you have a question, or you just want to tell us?
Well, it was just an exception to your rule.
Ah, got it.
And I thought I'd call up and give it as one of those few. And granted, I wrote it through 2009, and I just held my breath, and it worked out. By the way, another little tidbit: my wife's daughter was working for Amazon way back when, and she bought Amazon stock when it was $15 a share.
Yeah, I mean, Amazon. Yeah, it's you go back to the founding when it went public, it's up 30% a year.
Yeah.
Hey, that's a pretty good return. There's not a lot of publicly traded companies that do that. So
thank goodness for those, because those are the stocks. Those are the companies that make all of the money when you buy the market.
Yep.
The vast majority of the market's return comes from a very few very good stock. The problem is, and I'll give you a great personal example. The problem is, for example, I thought Amazon was a great idea many, many years ago, but you sit and you read and you study and you work really hard on it and you go, wait a minute.
Not making
Everybody's
money.
saying they're not making any money.
Yep.
There's no reason to buy this stock. There were as many reasons to not buy it as there were reasons to buy it. So it makes it very, very difficult to pick stocks for individuals unless it's a very special case where you just get lucky. You go, that's a cool product. I'm going to buy a little stock. And you know what you did, Carl? This is another thing that I don't mind people doing, is you played with a little money a long time ago. If you have a lot, you've saved and invested and you've got your nest egg building up in a diversified portfolio, and something comes along that you go, I think this is great. If you have some money that you can afford to lose if you're wrong, we're not opposed to buying individual stocks.
No more than 5%, I would say, of your portfolio. By the way.
Exactly.
So you want to see if we can squeeze one more in? Another call?
Yeah, we can.
Okay.
Yeah,
right.
we can.
Because John has been kind enough to stand by and now joins us on Talking Real Money. Hi, John. John?
Yes. Hi. The reason I called today, we're trying to set up a foundation or something of that nature as a gift, and it would be in excess of $100,000, and it would go into probably a 501c3. And we're looking for the most bang for the buck. In other words, most efficient from a tax and also a gifting standpoint.
What's the purpose of this foundation?
It's a remembrance of an individual.
Okay.
So,
but what do you want the money to do?
Who
will the money be going to?
It would be going to the foundation, but in such a manner that it would be paid out over time, like 4% of the principal. So it would continue.
Whom?
It would be to the college or the.
Okay. So you want to set up a foundation as to pay money to a college, but the problem is at $100,000, you're better off taking the deduction and giving it to the college's own foundation and letting them invest it and pay it out, because the costs of managing something, of establishing and then managing that, are going to eat into your return so dramatically that you might be lucky to give them 4% a year.
Okay. I see what you're saying. What I was looking at is the methods of distributing that, like going direct from the IRA to the foundation, and then looking at gifting appreciated stock or
donor advised.
Yes, or using Vanguard Charitable, or
I think those when you're in this range, if you were in the 8-figure range, then you can start looking at setting up your own foundation. Then it might start to make sense. But if you'll notice, most charitable foundations are in the 9-figure range, the vast majority of them. And because it is a costly process, there are a lot of legal loopholes you have to jump through. A lot of paperwork that has to be filed. It can be a very expensive process that eats up your returns. You're better off just finding an inexpensive way to gift it directly to the organization in the name of that person.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
You realize this is radio, that there is no physicality required.
Get up and get
All
moving.
you have to do is flap your lips for an hour. That's it.
Keep the energy level high. And by the way, I decided on the banana bread, not the fare. So how's that?
Oh, you did?
Yeah.
So, okay, yeah. And because I hate inside jokes,
now
I have to explain that.
Okay, quickly.
Tom's wife has a pizza cooking food truck thingy called Pompeii Pizza.
Yeah.
And they are at the Evergreen State Fair cooking pizza.
Mm-hmm.
And Tom has not seen his wife or daughter.
Not for like weeks. I don't know.
Ever since the fair started. So he, in a moment
conciliatory
of guilt,
guilt.
He thought, I should probably swing by and say hello. And that lasted for about, the top of the hour break. That lasted for about 5 minutes and 30 seconds.
That's longer than usual,
Then he decided, no, that's too much like work. I'm going to go home and make banana bread.
And watch sports.
Watch sports.
All right. So that's not what this show is about. The show is about you.
It's not about making bread. It's about making dough.
There you go.
But not that kind of dough. The kind that gets you to where you need to go. Okay? That was a little poetic.
Mm-hmm.
Where we think you need to go more often than not is to a comfortable retirement. Of all the things for which you can save and invest, the one thing that's going to require the most money, you got to believe us on this, we understand this pretty well, is retirement. You probably need somewhere between, if you're like most people, most middle-class people, the least amount you're going to be able to get by with is about $500,000. You probably need to be north of that. In fact,
but don't give up, because I do run into people that say, then I just won't bother.
No, you got to bother because let's say you're in your 50s and you've got little or nothing saved.
Yep.
Well, you need to get started, and that's the thing that we can do. We can help you get a plan together to get started, to find the motivation, to get it underway, because if you don't, here's the option. And I want to make it, I don't want to sugarcoat this and say that it's going to be wonderful, because the odds are, go look it up at ssa.gov. The Social Security Administration will give you an estimate of what your Social Security is going to be. And if you think you can live on that, then you live incredibly frugally.
Yeah, and sadly, it's about 40% of the United States that's in retirement. That's all they have. And we don't suggest it. It's a big, big, big number. So
no, it's not. You need to save. You need to get started. And so strike while the iron's hot. Get to it today. Get a plan. You need to get started. You need to understand what you have and where it is. And we know this for a fact.
I got another fact, but
most of you don't know what you own. You don't know what's in your investment portfolio.
Oh, you don't.
I got some stocks.
Yeah.
You don't know.
Mm-mm. You don't know what kind of stocks. You don't know what you're paying others generally. Here's the other part that always fascinates me. Most of you listening don't know how much risk you're taking. Yeah, and again, when I look at portfolios, people are either taking way too much risk for the amount of money they need to make, or they're taking no risk and they need to get some return on that money. Because I had a conversation with a fellow I worked with last night, different than the previous guy, that he admitted, I have most of it in something that's not making very much money, and I know in retirement I'll need to have my money grow to some extent, and it's this counterintuitive thing.
Let's see, Laney, I think you're next. Welcome to Talking Real Money.
Hi, Laney.
Hi, thank you for taking my call.
Our pleasure.
Our pleasure.
I want to open or set up an account to build funds for my 6 college great-grandchildren.
Oh, how exciting
so
for you.
They range from 2 to 18.
Okay.
Wait, a college fund for all of them?
Right, yeah. One so they can draw from.
Yeah.
The 18-year-old won't have much, but the 2-year-old hopefully will have.
Yeah, I mean, with the 18-year-old, honestly, just giving them the money for college at this point, there's no reason to put that in a college fund like a 529 at this point. That's just you're going to hand it to them. But for the 2-year-old and the younger ones, and by the way, congratulations on 6 great grandchildren. What a gift. I would go to Utah, UESP.
Not literally. Don't drive to Utah, Laney.
Wait till Don comes back. He'll give you a quick lift there. He likes that.
I've been through there, and it wasn't that great.
So we would recommend the Utah 529 plan. Utah 5. The money could be used for any school, higher education, anywhere in the country. And it goes like this, Laney. Here's the part that I love. It's easy to set up, and if you weren't, technologically oriented, you could have somebody else do it for you. But you can do this online very easily for each of the great grandkids. You would then they do all the work. They do what's called age-based investing. So, for example, for the 2-year-old, they're going to have most of that money in low-cost index funds that are in stocks, because stocks, over time go up more than the safer things like bonds, if that makes sense. A riskier portfolio for the young'uns, and then less risky for the kids who are closer to college, because you don't want volatility when you're going to use the money.
I'm in South Dakota. This is where they call them young'uns, not in Seattle.
Okay, pardon me.
Laney, are you comfortable on the computer, or would you rather call them?
I think my computer is not always working well, and
let me give you their 800.
We have problems.
Let me give you their 800 number. Give them a call on Tuesday and tell them what you'd like to do, and they're very helpful. They will help you get all the paperwork done and get these started for the great grandkids. Their number is 800-418-2551. That's 800-418-2551. It's called the Utah Educational Savings Plan. You don't have to go to a Utah school. You don't have to live in Utah. It's just a very well-run plan with very low costs and the kinds of funds that we like to see in a portfolio like this.
Great.
800-418-2551.
Yep. There you go.
Call them Tuesday.
Or one account for all.
You have to have one account for each child, each grandchild.
Each child would have an account. And again, as Tom said, the 18-year-old, if they need money for college, just give it to them. Although I have another idea you might want to consider, and that is setting up, if they've got any income, if they don't need money for college, then you might want to set up a Roth IRA for them, for the older child, so that they start saving for retirement. But if it's for college, just give them the money. Okay?
Thank you so much.
Thank you, Laney.
You're very welcome, Laney. Thanks for the call.
6 great grandkids. Wow, that would be awesome.
Yeah, I think
I'm just excited about my first grandson. So.
My mom has a slew of great grandkids. She's
that many?
All over the place.
That's
amazing.
I
think it's like 8 or 9.
Wow.
How many great grandkids does my mom have now? 8.
8.
Oh, 13 grandchildren. How many greats?
And 8
5. Yeah. Okay. She's got a lot of them.
Yeah, that's okay.
Richard's up next. Hey, Richard, welcome to Talking Real Money.
Hi, Richard.
Hi. So I guess my question is kind of 2 parts. So we had this only mom's house, and we moved it we've already had a trust, and so we put the money into the financial institution that's the trust, but it's sitting in cash, and it was a house, so I don't have an advisor. And so what rate should I look for, and how do I pick an advisor?
Well, wait. Okay, first, I want to ask you a question. So this is in a trust, correct?
Yes, a trust, yes.
So it's in a trust account at a bank?
It's not at a bank. It's in Commonwealth Financial Network.
I don't know Commonwealth Financial Network. So is that a brokerage of some kind? I mean, so it's a custodian.
It's similar to, it's like, Schwab or Fidelity.
It is. Okay, I'm not familiar with them.
Who's the trustee?
A group of us sons.
Oh, okay. So as trustees, you can put this anywhere you want.
I was just getting to that.
Yeah.
That's correct.
Yeah.
I don't know Commonwealth.
Right now, but what's an acceptable? I started digging around, and rates are all over the thing. And so it's like, how do I make sure the guy knows or gal knows what they're doing to give us good advice, and what's an acceptable rate that they should be earning?
You will. Okay. We confuse this banking concept with investing a lot. You get a set rate of return on a bond or at a bank account. You do not get
not the rate of return, but the rate that I have to pay the.
How much should you pay somebody for this help? You had us leaping through pages, going, I don't know what rate. Go ahead, Don.
You should never pay a commission.
We don't want you to pay any commissions on any product. Number two, if you're hiring somebody to manage this trust for you, we believe that you should not pay that individual, that company, more than 1% a year. But here's where it gets tricky. I also don't want you to use mutual funds that cost more than 30 or 40 basis points. So in total, we don't think you should be paying more than 1.3% a year or so.
Previous caller mentioned he had some money at Commonwealth Financial Network. They were holding this trust.
Which I've never even heard of. So,
by the way, they're huge.
Okay.
They have thousands of advisors, in air quotes, all over the country. They're both an RIA, a registered investment advisor, and a BD, a broker-dealer.
Which means they can sometimes be your fiduciary and sometimes not so much. Yeah.
It depends on what they're selling.
Yeah.
They sell actively managed funds. They sell funds with 12B1 fees. They also sell Vanguard dimensional funds to people, which really surprised me. Surprised me. Apparently they can do anything for $1. And what a buck they get.
How much?
Remember the caller asked what kind of fee should he pay?
Mm-hmm.
Well, their fee starts at 3%.
No.
Yes.
3% a year?
I went to advisorinfo.sec.gov, sir.
Good Lord.
And looked up their ADV Part 2 brochure.
Wow, that's
so
honestly, that's outrageous.
But it goes down. It goes down. So if you have a $500,000 account there, your annual fee will be a mere 2.25%.
Okay, but that's an outrageous statement.
I'm being facetious.
Well, no, but here's the thing that troubles me about the fact that Commonwealth. So here they hold themselves out. Here's what they're going to say. Oh yeah, we use index funds. You should use index funds because they're lower cost and they get you the returns of the market over the long haul. And but then this whole
then we suck 2% out.
I do see that from time to time. They tell the story, but then when it comes down to actually managing the money, that is insane to pay somebody that much.
You want to guess what $1 million to $2 million is?
Well, let's see. You went down to I'll say 1 to 1.5.
1.75%, sir.
1.7.
Ridiculous. That is just outrageous.
That really is. Do not pay that, please.
Yeah, well, their cheapest fee for
how about $20 million? What are we at there?
At $20 million, you're at 1.5%.
No.
Yes.
I can't. That's really tragic. If you're paying that, it really is.
It's sad. I don't get it. Yeah. Del, you're next. Welcome to Talking Real Money.
Tell us you're not paying somebody 3% a year to manage your money, Del.
I had a question about traditional long-term care versus hybrid in regards to switching over.
Yeah, so I mean,
you're talking about the asset-based policy where you buy in.
Because this comes up from time to time. I actually heard somebody when I was driving in today talking about this, and the answer they gave was very good until the moment they said, "Here's a guy I know who's a broker. Call him up." Because and by the way, the other part of the answer I liked is if you go to the insurance agent, they're generally going to sell you the policy that probably makes them more money. Not saying anything bad about insurance people, but it works out that way. Don will, by the way.
Funny how that works.
So the short answer is, Del, I don't know, because we'd have to look at your situation in terms of your assets. We'd have to look at your situation in terms of your age, your health. There's a lot of factors that go into this. Here's my personal preference. And I will preclude this by saying I like transparency. I like simplicity in all things, by the way, in my business, in my personal life. I mean, and in my finances. I have a lot of insurance because it troubles me. I have a 9-year-old daughter. It troubles me the idea that I would drop dead or somebody kick me in the head at a high school game, whatever it is, and they wouldn't be taken care of. So that part of my life, I feel like I've checked the box. I like that fact that that's separate from my investments. My investments are in low-cost index mutual funds. I believe that's the best way to go. So then when you start getting into, you could have a traditional long-term care policy where you just pay the premium, and here's the struggle, I get it, that you buy that policy and then in 10 years the premium is doubled. This has happened a lot. I understand that. Or this asset-based model where they say you give us the money, you're going to get the money back at the end, and here's how much you're going to, it makes it cloudy for me.
And every one of these that I've looked at and I've looked at quite a few of these asset policies, these buy-in policies. Every single case, they have built in to the policy so many protections for them that you're not going to be and even if you get deathly ill, you're not going to be any better off. They have caps on what they pay. You're not going to be any better off than you are in a traditional long-term care policy. And the net at the end of the day is almost exactly the same.
And by the way, we have a guy actually does work for us that we pay per hour. We bring him the policies. That's one way. But here's another: hire a financial advisor on a per hour basis. Have them look at your financial situation to say it makes more sense to do the asset based, or it makes more sense just to buy the policy. That's not an agent. That's why.
That is not an agent. That's the key. If you hire an advisor, and you should, to look these options over for you, make sure they do not have an insurance license and can't sell product.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
We want you to discover a better way to manage your money, to manage your wealth, to build it up for your future than what you've probably been doing. And we're pretty confident that what you're doing is most of the time not in your best interest, just from experience and from statistics. I mean, there are studies that will show you that only 1% of all investment advisors are always required to act in your best interest. That means 99% can do things that aren't the best for you financially. Now, there are conflicts. Everybody has a conflict,
we want you to be our clients.
Right, that's our conflict.
We have a conflict. It's better if you're a client, but you don't have to be, but it's better.
But we would rather see you go with somebody who believes what we believe than go with all the other folks. I mean, we don't sit around and say, call us at the office. We want you to call the firm that always acts in your best interest. And I don't mean to pick on Commonwealth.
Well, but I'm going to pick on them because let me finish my thought on Commonwealth, because I don't know that we make this explicit enough. If you're paying somebody 3%, as the manager, as the investment advisor, and the cost of the mutual funds. Remember, this is the part that people forget. There's a charge to the way the money's actually. They're just the person giving the advice. Then the actual investment vehicle costs 1%. For sake of argument, that's 4% a year. If the stock market gives you 8%, all of a sudden you've given away half of your money each and every year. That is outrageous. It really is.
And I wouldn't expect the stock market to give more than 8% on average anymore. I really wouldn't expect that. You're giving a lot away. But I was reading their conflict, and this is one of the things. Again, go to advisorinfo.sec.gov. Anyone who holds themselves out to be an investment advisor must file a form with the SEC, which is reasonably easy to read.
Yep.
It's called their ADV Part 2 brochure, and I was reading through Commonwealth's, and they, in their conflict of interest section, just look for that. And in their conflict of interest section, they say all of our advisors are registered with almost all of our advisors are registered with Commonwealth's broker-dealer as registered representatives.
They need to wear the hats, the Don's hats.
I'm selling those hats.
That's a work.
And many are licensed insurance agents.
Really?
So you shouldn't get advice on your money from someone who gets commissions from selling products because, folks, the advice is tainted. No matter how nice they are or how honorable you feel they are or they believe themselves to be, because remember, human beings are so good at deluding themselves.
Well, I mean,
we convince ourselves that we do good work.
Put yourself in that situation. It's pretty simple to figure out that by the way, this, and I'm hearing myself twice here, Don, but the reality is, I don't either, but the reality is that when you sit down with somebody and you ask them for help, and the way they can help you, I'm using the air quotes, the way they can help you is either put you into a low-cost index fund that makes them very little, or into a high-expense fund that pays them a big commission, a product that makes a lot of money for them. Put yourself in that spot. Which would you do? You would have to pick B, right? Because that makes you a living. That pays the boat. That takes the kids on vacation. Whatever it is, it's just incredibly hard. And remember, though, the broker-dealers have a fiduciary responsibility to the broker-dealer. They have a requirement to put the firm first, sadly.
And that is sad. And that's, again, why I kid about it, but I'm somewhat serious that they should be required to wear another hat. They should be required to change the hats from I'm acting in your best interest to I'm acting not necessarily in your best interest. I'm giving you something that's merely suitable. And that's one of my pet peeves, that they don't do that. So the point is, and that this applies to a lot of folks who called today. The gentleman who was who had that money, that trust money with Commonwealth, the gentleman who was talking to someone about that insurance policy.
By the way, it would even hold true with a 529, because there's people that sell commission-based educational savings programs. Lots of them. Lots of states have crummy programs that have commissions attached to them. Why would you hand somebody? No, why would you want to overpay for something that's going to take care of your great-grandkids? Absolutely not.
And the problem is, it's hard to know who to trust. That's why we're trying to give you the tools you need. There are just a couple of them. Again, that website, go look your advisor up. I bet you've never done it. Go look them up at advisorinfo.sec.gov. Type in the name of the firm or the name of the person you work with. Go to that ADV Part 2 and sit down. Spend 20 minutes skimming it. You don't have to read it. Take 10 minutes and skim the darn thing. Go to the fees section and go to the conflict of interest section. Those are the two you need to read.
Well, and the other part is get some education about this. Because if you just walk into somebody and give them your chips, your savings, you don't know what's going to happen. That's why we do the classes. We've got one coming up on the 12th in Olympia. We've got a Retire Meet South coming up on the 28th of October. Don's going to do a lunch ed here in the interim, and those classes are all at talkingrealmoney.com, talkingrealmoney.com. If you go to the homepage, right at the top, it says attend one of our events. So, and we don't get to the South Sound enough. That's why we're trying to do more down there. So join us for the 12th or the 28th of October for those. So if you have some education, you could at least put up some sort of argument with people to tell you, here's the way it is, sonny boy, because no, that isn't the way it is. I've learned something, and I don't have to just blindly follow your advice.
And one of the things that I don't think we mention enough is that we promise you, and in fact, I guarantee you have to pay for our classes, because we don't want to spend our clients' money on these, because they're classes. This is not a sales pitch. You're not going to walk out of this thing going, oh my gosh, they just got me to sign up for the long weekend seminar. And then
after that, it's...
Can you imagine spending a long weekend with us? Oh, gee whiz, no.
No way. Not going to happen.
But that's what you get. You either get sold a seminar, or in some of these college classes, you get sold an hour-long meeting so the guy can sell you an indexed annuity.
You get your private meeting.
Meeting,
of course, your private meeting.
And right, you've listened long enough that you know that equity indexed annuities are evil. They are evil. And I'm not the only one who says that. I can feel pretty good about saying that when I am backed up by Forbes and Kiplinger's and Money and FINRA, the Financial Industry Regulatory Authority.
Put alert out on them. Yep.
Yeah. Oh, they have an alert. FINRA has an alert that says, these things could be really bad for you.
Might want to check into it. Yeah.
If it sounds too good, please know that 99 times out of 100, it's too good. It's just too good to be true. You got to watch out for it. And make sure, I want to go back to the two tools. There are two tools. Advisorinfo.sec.gov to look them up, or go to talkingrealmoney.com and download it's a one-page, one-side PDF that we call the advisor interview form. It has, any decent advisor, it'll take them 30 minutes at most to fill it out. And if they refuse to fill it out, then walk away.
You got to find somebody else to help you. Yep, I agree.
Find somebody else. You are not in the right place. You've got to do this little bit of homework to make sure you get taken care of as well as you can be. Doesn't guarantee anything, but it improves the odds, and it levels the playing field.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.